Hello, Corey here with the Cyclical Investors Club YouTube channel, and this video is going to be about Wells Fargo stock and why I think investors would be wise to avoid it. I have a few standard things that I look for stocks that kind of alert me that they might be value traps, and this one in particular that I'm going to talk about in this video has saved me lots and lots of money, because sometimes stocks look really good, the price looks good, even the earnings recovery that might be expected looks good, or earnings might look okay, but the key thing that you need to focus on here is revenues, in particular what the revenues for the past 3 years look like. If I look at 3-year revenues and they're negative for a stock, I avoid it unless we're in the middle of a recession. Okay, so like if you look right now, we're in a recession. If it's a business that's been affected by the recession, you expect revenues to be lower than they were before the recession, even if it's a couple years before the recession. But when you look at Wells Fargo, what you see is that even before the recession, their 3-year earnings trend was negative. And it is really just a red line for me. I mean, sometimes even if revenues are just barely positive, that's enough to keep me away from the stock. But if the 3-year revenue number is negative, I avoid it. I'm sure there are times where companies can turn things around, there are turnaround stories, but they're so rare and so hard to predict that I found it's best just to avoid them, and go find something that's easier, that's better, that's not so hard to figure out, and that doesn't have as much risk. So I'll, after a quick disclaimer, I'll go in and show you just some of the graphs. This is going to be a pretty short video. And then before that, I'll go check and see how some of the other avoid ideas that I've shared on the channel are turning out so far. All right, let's go. Okay, so I have a little spreadsheet here on some of the other stocks that I've suggested avoiding this year. And if you've been following this each week, you'll see that Franklin Resources had been kind of bucking the trend, and it was up quite a bit. They released earnings, they were disappointing, and so now they're still up from when I suggested avoiding them, but the stock price fell down quite a bit, so it's just slightly up, and now it's trailing the S&P 500. Again, IBM, Illinois Toolworks, both still negative and both still trailing the S&P 500. Now, we had a big up week in the market last week, and it looks like we have some stimulus coming down the pike here from the government, so that helped Carnival out. It was down quite a bit, I think, the week before. I forget exactly, but it got a big boost from that. Tesla also had a big reversal and had a big boost, so these guys are doing okay so far after just a couple weeks. And overall, these guys are actually positive, but when you average them all together, they're still not up as much as just a basic S&P 500 ETF. So overall, they're still trailing the S&P 500, and I expect over time, as time goes on, especially if the economy ever gets a little sketchier, the recovery doesn't come quite as fast, we'll start to see cracks here and there, kind of like we saw with Franklin Resources this week, where at first the market was really positive, and then once earnings came out, they're like, oh, it doesn't look so great. And then, so it's going to take several months or maybe a couple of years for these to play out. But right now, they're still trailing the index, and we'll see how it goes long term. All right, I have a quick disclaimer, and then we'll get into looking at some charts of Wells Fargo. Hello, everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club Premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, let's get into today's. Okay, I didn't fill in a lot of this information for Wells Fargo because basically the 3-year revenue will trump everything. So no matter how good the stock looks on any other kind of basis, if the 3-year revenue is negative, then I avoid the stock. Now this negative 18%, that's a cumulative 3-year revenue decline. So on an annual basis, you're looking at like 6% per year, but from 3 years until that point, the point this is measured, Wells Fargo brought in 18% less revenue. Now, importantly, since we're in the middle of a recession, this actually doesn't measure the revenue up to the current date here in February of 2021. I actually started this in March 1st, 2017 and ran it up through March 1st, 2020. So this is before the recession started. So before the recession began, these guys had a significant revenue decline. And that's how I knew, even in March when all the prices dropped really far, I knew that avoiding Wells Fargo was a good idea. And I bought a bunch of different other banks. I bought PNC, I bought US Bank, I bought like 3 smaller banks, and then some asset managers like BlackRock, Ameriprise. So there were plenty of other great values. Those stocks have returned in between 80 and 150%, depending on which ones we're talking about, whereas Wells Fargo really hasn't returned that much. So now it's important to think about when was this first trigger alerted? Like when did the 3-year revenue first tip negative for Wells Fargo? And it was about right here. So they had a stock price decline. You can see this big jump decline here. That was right after they reported kind of really sketchy revenue. Okay, so about the end of 2018 going into 2019. And as you can see, the PE was only 10 or about almost 11 there. It could have looked like a pretty good investment, but because the revenue was so sketchy, I stayed away. Now, if you would have bought that dip, I mean, short term, you would have done okay. You would have risen a little bit. But from there to today, the stock is down 22%. Okay, so I avoided that basically, and then I had cash available to actually invest in a good company. So now, during the March decline, if you would have bought right at the low, okay, actually it kept going down. Let's look. Yeah, these are average prices. So we can just pick the bottom. Let's say you pick the bottom back in October to today. You'd be up 50%. Okay, that looks pretty good, all right? If you really could find a way to bottom pick that, not even in March, but to have the patience to wait until just a couple of months ago. So there are going to be people right now that are going to say, oh, I bought Wells Fargo and I made some money on it, and that's true. But long term, the odds of this stock getting and making new highs, which would be $65 per share, so the odds of the stock doubling from here are quite low in the next, say, 5 years or whatever. Whereas if you compare this, and I'm going to use one that I actually bought, well, that's similar. So we'll just use PNC as an example because it's probably the closest example that I can think of a stock that I actually bought in March. So I bought this one in March, very close to the bottom. I don't know the exact day. And again, Fast Graphs uses monthly averages, so this isn't going to be exactly right. But you would be up 68% using the monthly average. I can tell you just from my personal investment that PNC is up almost 100%, if you include dividends from when I purchased it. So, and it's almost back to its old highs again. Okay, so that's the difference between a quality company and one that's going through tough times. Now, that doesn't mean Wells Fargo couldn't turn things around. They absolutely could, but it's very hard to predict that, and it's very hard to predict how much they'll turn it around. It's harder to predict when would be a good time to take profits, unless you're using some sort of momentum strategy, which I'm not using for banks. I integrate a little bit of it when I go to take profits because I use trailing stops and things like that, but really on a fundamental based approach, Wells Fargo doesn't look good. And if you look at this decline, I mean, Now they have a reputation. They had a reputation as a high-quality bank because they did reasonably well back here during the financial crisis. I mean, they remained profitable on an annual basis. So they barely are going to remain profitable during this, and they just performed much worse than many other banks. And it can be tempting when you look at, well, up here they're showing a 52 PE, but if you use these forward earnings, you know, at a 15 PE, they would be valued higher than they are now by like 20% maybe. So you could look at these forward earnings and say, oh, there's still 20% upside. Well, maybe, but you're taking on a lot of risk, and I would rather take on risk with a quality bank that I know that I can just hold for the long term if I have to. All right, so that's why I would avoid Wells Fargo, and really I would avoid any less cyclical stock, or as long as you're measuring the revenue up into peak earnings before a recession, then it doesn't really matter, but you want those revenue growth to be positive, okay? If it's negative, just avoid the stock. That'll save you lots and lots and lots of money, and it's the simplest value trap indicator that I've run across. I mean, especially considering how accurate it is. All right, if you found that helpful, subscribe to the channel. I come out with new videos every week, and I always have some buys, some avoids, some sells. I usually have a video where I just talk about general topic that's on my mind regarding investing, and I'll see everyone later.